Question 7, Lab 3, for all my loyal viewers. Hopefully what we can do with this video is clarify exactly what that question was asking and how it differs from regular adjusting type questions. To make it very clear here, usually we adjust in the next period or the next month, which could be the next period, right? Depends on how often the adjustments are made. But you're given that additional info for the next month or quarter or year, and then you make that adjustment at the end of whatever the question's asking you to make it at. But in this question, you're given the unadjusted trial balances for each account, and you're given some additional information A to I. And by the way, I wrote down the details of the question here in my notebook. I'll be making some points on the board. But a lot of this video will just be verbalizing and explaining exactly what is occurring in each of these adjustments. But the difference is that you're given that unadjusted trial balance as well as adjusting information within the month that it's asking you to record the adjustments. So this company is doing their adjustments in October, every year in October, which could mean that their fiscal year is ending October 31st, starting November 1st. Remember, fiscal years are when the 12-month period that the company is recording their accounting. It could be based on when the company opens. It could be based on, if it's a seasonal business, when the business is hot, when it's not, okay? And in this case, they are ending on October 31st. That's when they're doing their adjustments, right? So the first thing this question is asking you to do is transfer those provided amounts in the unadjusted trial balance. Remember, unadjusted trial balance, step 3 in the accounting cycle. So you're starting in step 3. Step 3 is actually provided. So you're starting in you're kind of going back to step 2 a little bit because you're recording the unadjusted balances into the ledger, right? Ledger again is step 2. So all you're doing, first step in this question, is to copy those balances. If it's a debit in the unadjusted trial balance, find that specific ledger and debit it there. Credit in the unadjusted trial balance, find the specific ledger, credit it there. So it's copying. Now you're given A through I adjustments for certain accounts. And again, those adjustments are happening within October. That unadjusted trial balance, we could assume are numbers from October 1st. And now we need to do the adjusting update on October 31st. Therefore, all of those adjustments, A through I, occurred within October, between October 2nd and October 30th or 31st. Okay, so that gives you a broader outlook on what the question looks like. And now, instead of journalizing each of those adjustments, left column, write out what you're debiting. Next line, indent a little bit, write out what you're crediting. Instead of doing that, okay, you are putting it into a ledger. And remember, the same way you do the journal entry is the way you are treating the accounts in the ledger. So really, in effect, you're doing the journal entry inside the ledger by showing how these adjustments affect each of those appropriate accounts. So let's go through each of these separately. Again, my numbers might be different than yours, but the question is exactly the same. The adjustment is exactly the same. So just use your numbers as you're going through the question, and everything will be great. It was determined that 11,900 of the unearned consulting revenue hadn't been earned. This is A. 11,900 of the unearned consulting revenue hadn't been earned. So now you have to compare it to the number provided in the unadjusted trial balance for unearned consulting revenue. The unearned consulting revenue balance is 25,800. Okay. Unearned consulting revenue $25,800. And this is a dash, not a negative sign. So this 25,800 in general represents a liability that we have to still perform and earn. Right? Unearned revenue is a liability. That means it's a natural credit balance. 11,900 of this at the end of October has not been earned yet. Which means how much has been earned? That's the adjustment you make now. You have to record at the end of October how much of this 25,800 has been earned. That's the adjustment, converting it from an unearned revenue to an earned revenue. Okay? So 25,800, again from the unadjusted trial balance, minus the 11,900, because that is still unearned, still needing to be performed by us, either a service or a product. Therefore, the difference, okay, 13,900 represents what has been earned. It is earned revenue that we can claim in our income statement this month. Right? The unearned revenue comes from the liability section of the balance sheet. The earned revenue, this 13,900, is entitled, if we can put it in this way, to be on the income statement as a earned revenue. We know we have to debit something first and then show our credit in the journal entry. And again, in this question, we're doing the journal entry in a ledger. So we find the two accounts that are affected. First, the debited account. We know unearned revenue is a liability, which is a normal credit account. But since we have earned some of that 25,800, that earned portion decreases unearned revenue. So unearned revenue gets debited for this 13,900. Unearned revenue debited because we've earned it now, and therefore the credit in that entry is consulting revenue, which is the earned revenue for 13,900. So you go find those two ledgers, unearned revenue, and debit it for 13,900. Find consulting revenue and credit it for the 13,900. And now you've made that conversion, demonstrating one of those categories to be adjusted, unearned revenue. That's A. Okay, that's A. B. Okay, what does B say? It was determined that 13,900 of the balance in the consulting revenue account was for services to be performed in November. Services to be performed in November. So they're telling us that the number provided in consulting revenue, in my case, 231,020. So I'll just erase the word unearned here. Now we're on B. erase it all to not be confusing with A. I don't want to mix the numbers up. 231,020 is the number provided in the unadjusted trial balance for consulting revenue. Okay, here's the short form, CONS period, REV period, consulting revenue. That's the number provided. 13,900 of that, according to B, has to still be performed the next month, in November. Which means that 13,900 of this cannot be considered real revenue now at the end of October. Cannot. And if it's not real revenue, it is unearned revenue. Therefore, we are really doing the opposite of what we did in A. In A, we transferred unearned revenue to real revenue. Now in B, we're taking real revenue and transferring it into unearned revenue. You got that? And why are we doing that? Because we have to make that adjustment on October 31st. We could leave it alone if our adjustments happened at the end of November, on November 30th. But since we do it on October 31st, we have to specify how much of the revenue is earned and how much is not. So in B, 13,900 of this 231.20 becomes unearned revenue. And therefore the debit this time is regular revenue. Regular revenue. The consulting revenue here, consulting revenue, go find that ledger, debit it for 13,900 to show that the real revenue is decreasing. And then the second account is to go find unearned revenue, the liability, and credit it to show that the liability is increasing by 13,900, which we're going to have to fulfill next month in November. Okay? A and B are mirrors of each other. Hopefully you got that. Got that point. Then, okay, so yeah, so that 231 doesn't get affected in B in terms of doing any minusing the 13,900 from it. The 231,020 for consulting revenue, which we got from the unadjusted trial balance, that remains in the consulting revenue ledger as a credit, and now we just go to the ledger and update it by debiting that ledger for 13,900 consulting revenue, and then crediting the unearned revenue account for 13,900 to balance this entry. All right? Now we can go to C. The balance in the prepaid rent account represents 3 months of rent beginning September 1st, 2017. The balance in the prepaid rent account represents 3 months beginning September. So beginning of last month, we purchased prepaid rent. Prepaid rent, the provided number is 26,700. C. Okay, I'll say pre-rent 26,700. All right. This I'm getting from the unadjusted trial balance. So we already have updated the prepaid rent ledger by debiting it for this 26,700. Prepaid rent is an asset. You've debited it. Now, 3 months of rent. This amount represents 3 months starting in September. And we're doing the adjusting when? Exactly. Put the kids to bed, you check their candy already, and now you're doing the adjusting entries. September 1st to October 31st is how many months out of the 3? It's all of September and all of October. Therefore, we divide this 26,700 by 3. Divided by 3. Just do some 26,700 divided by 3 months. And since it's covering 2 months, we times that monthly rate by 2 to get 17,800. So 17,800, just making sure, okay, covers 2 months. The amount we have used. So you got that? It doesn't say remaining. It doesn't say that this 26,700 is the remaining balance. It says it's the full balance from September, which means it's just been carried over. The same amount. We haven't changed this 26,700 since purchasing that prepaid rent on September 1st. So it's the full amount. That's why 2 months of that full amount can be calculated here. And what happens when you use something? If it's employees, if it's rent, if it's electricity, what happens when you use it? It becomes an expense. So, prepaid rent turns into what kind of expense? Rent expense. Go find the rent expense ledger and debit it for 17,800. Because you're taking the account you're debiting first, just as you would in a journal entry. And by the way, you would regularly journalize these in regular accounting and then post them to the ledger as we're doing. But this question is asking you to just directly show the changes in the ledger. And therefore you don't have to journalize it, right? But the treatment is the same anyway. Debit rent expense, 17,800. Credit, what? That's right. Prepaid rent, the asset. We have to show how the asset is decreasing. So credit prepaid rent for the same 17,800 in C. All right. Okay, that's C. Okay, on to D. D, accrued wages at October 31st totaled 6,700. Accrued wages, let's just take the word accrued for now. We know accrued expenses and accrued revenues are two other categories of adjustments, two other types of accounts that could be adjusted. And if it says accrued expenses, that means we still have to pay something. Accrued means we still have to do something. If it's accrued revenues, that means somebody still has to pay us. You see? So accrued is automatically implying, if it's an expense for us, that we have incurred a payable. That's why we associate accrued expenses with payables. Because our employees have worked, but we haven't paid them yet. On October 31st, we haven't paid them $6,700 worth. So this is really new balances in the ledgers of wages expense and wages payable. Because I don't believe those two had balances from the unadjusted trial balance. Our wages payable was 0. Wages expense, yeah, wages expense does have a balance actually. Wages expense does have a balance of 191,000, but we're adding to that expense $6,700. Therefore, both of those numbers on the debit side of the wages expense ledger, the $191,000 from the unadjusted trial balance, and the new $6,700 from this adjustment in D. And then go find the wages payable ledger, which has a zero balance to start off, and we're adding to that on the credit side $6,700 because we still have to pay it. Incurring a liability here in D. So that one's pretty clear, right? Accrued just means it's yet to be paid. If it's accrued expenses, we have yet to pay it. If it's accrued revenues, somebody is yet to pay us, which means it would be a receivable, right? Okay, E. The office furniture was purchased on March 1st, 2016 and has estimated useful life of 2 years. After the 2 years of use, it is expected that the furniture will be worthless. So if it's going to be worthless, that means its salvage value could also be called residual value, is 0. Whenever it's a depreciation adjustment, we need to find out how much are we depreciating. And we learned from the previous, or from the chapter, the accounting equation video actually, chapters 3, 4, and 5. Chapters 2, 3, and 4 for UHRM students, is that the adjustment requires the straight line formula. And we learned that one formula for depreciation for the purposes of this course is taking cost of that capital asset minus salvage value or residual value over useful life. And by the way, the capital assets, anything that is long-term, a long-term asset, in this case office furniture, you can expect office furniture to last you a considerable amount of time, therefore it qualifies as a capital asset. So it was purchased in March 1st of 2016, but it doesn't tell you in the adjustment how much you paid. Therefore, you have to go to the unadjusted trial balance number given to you for office furniture. In this case, it's $83,000. So in E, $83,000 for office furniture. Okay, office furn. That's how much we bought the office furniture for on March 1st, 2016. And now it's telling us its useful life is 2 years. After 2 years of use, it is expected the furniture will be useless. If we take our formula, we take the cost minus salvage value, sal value, over useful life. Plug in the numbers. What's the cost of the furniture? Here you go. $83,000. Minus the salvage value, it's telling us it's going to be worthless at the end of 2 years. So, 0 over useful life, 2. Okay? We purchased it on March 1st, 2016. We're doing this adjustment on October 1st, 2017. That means it is still going to be used a little bit in 2018, up until March 1st of 2018. Therefore, we need to adjust for one of the years, since one of the years of that furniture has been used up. One of the years of its expected life. You see? That's why dates are important here. When did you buy it? How long did you expect it to last? And how long has it lasted relative to that expectancy? Okay? $83,000 divided by 2, 41,500. 41,500 per year. This asset is depreciated. You can also call this 41,500 the cost of owning this office furniture per year. What is the yearly annual cost of owning that piece of furniture, or if it's a set of furniture? What is the cost of owning it for 1 year? 41,500. Right? So you're clear on that? Why it's 1 year that we're adjusting for? 2016, and now we're in 2017. In October of 2018, we will depreciate that remaining 41,500. Because now 2 years, the office furniture is gone. Now you got some kind of Victorian furniture taking its place in 2018. Or maybe you like IKEA better. Either way, 41,500 for this year. We know that that original 83,000 cost of any capital asset remains untouched. You do not change that balance in that asset account. So the 83,000 for office furniture will remain there. We do not go and locate that office furniture ledger now. Instead, depreciation, accumulated depreciation, the account we introduced last in the chapter 2, 3, and 4 video, accounting cycle video, accumulated depreciation being the contra asset related to capital assets, which is the account you credit. If we've used the furniture, what has to first be debited though? Again, you've used it, that means it's an expense. What kind of an expense? Depreciation expense. So let's go find the depreciation expense ledger, dash office furniture to specify which capital asset it's connected to. Debit it for 41,500. Depreciation expense office equipment, debit 41,500. Then go find the accumulated depreciation dash office furniture and credit that for 41,500. There you have it. And when you now prepare your balance sheet, the accumulated depreciation will go right under the office furniture listing in the assets section of the balance sheet, and then a third line will say net office furniture, which will be the 83,000 minus the 41,500 accumulated depreciation to give you 41,500 remaining net office furniture. That's how the calculation is shown. But notice the office furniture stays at 83,000. Okay, so that's a depreciation adjustment. And dates, again, are important here. We can go to F now. What's happening in F? Accrued consulting revenue talking about accrued consulting revenue at year end totals 4,100. This is the opposite of D. D was accrued wages totaling 6,700. Accrued wages meaning an expense in the form of paying employees, wages they have earned. F is saying we have earned revenue. We have been the ones who have earned the revenue and therefore can expect payment. But we haven't received it yet, therefore it must be a receivable, accounts receivable. Accrued consulting revenue at year end totals 4,100. Accounts receivable is the asset. Let's go find that in the ledger. Debit it for 4,100. The asset is increasing. We're awaiting payment for revenue we have earned. It'll probably be paid next month. Credit tells you in the entry. Consulting revenue. You have earned the revenue. You can consider it revenue even though you haven't been paid the cash yet. Remember, revenue gets recorded in the period that it is earned. That's the revenue recognition principle. And then, of course, the expenses that are incurred by you striving to generate that revenue also get recorded in the period that they incur, along with that revenue, therefore satisfying the matching principle. All right? That's F. Okay, G. Interest of 84 has accrued on the notes receivable for the month of October. Okay, notes receivable, notes payable. I think it was the chapter 1 video where we were talking about all of the different accounts, and then we said that there's a notes payable very similar to a accounts payable, excuse me. They're both liabilities, they're both short-term liabilities. The distinction is that the notes payable has a note attached to it promising to pay. The accounts payable is just you paid for it with credit and that was it. But the notes payable has a note on top of that promising to pay. It's similar with a notes receivable. Instead of us writing the note for a notes payable, a customer has written us a note for notes receivable. Okay? And many times, if it's a notes payable or a notes receivable, interest will be associated with that. And in this case, $84 has accumulated on this customer's notes receivable, on what this customer owes us in the form of our notes receivable. Okay? So they wrote us a promissory note to pay. And all we are adjusting here is the interest that has accumulated on that debt of theirs, their debt. Therefore, you can, it depends on the company, you could put it as an accounts receivable, as the debit, because you're expecting payment of it. But if you want to get even more specific, you would call it interest receivable. And this is good when you're actually looking at the questions to refer to the ledger where the trial balance is provided to see which accounts they are already using. If you're given some information in a question, then just use those same accounts, so you're not wondering what account to use, especially with the assignments or the labs or the tests. Of course, I looked them over myself, but if you're ever wondering or stuck on what account to use, just refer to what is already provided to you. In this case, the ledger is provided to you. You just have to fill it in, and the unadjusted trial balance is provided to you with all of the account names as well. So there's two places to see the accounts to where you can specify interest receivable here instead of accounts receivable. Right? If you put accounts receivable for that, you are correct in essence, right? Because it's still an asset awaiting payment, awaiting to be collected, but if it's given to you, then just be consistent with what it's already using in that from its chart of accounts. So interest receivable debited for this $84, okay, for the month of October. And if the interest has accumulated, we have earned the interest, we've earned it, and therefore go to that ledger and find the appropriate account. It'll say interest income. Again, interest income is revenue. Anything that says income is revenue. as well. So interest income increases revenue, increases equity. By increasing net income. So interest income is the account to credit here. You go find that ledger and put the $84 on the credit side of that specific ledger. Okay, again, all the adjustments are happening within this adjusting month of October. Okay. H. This is the one we had some fun with in the discussion board. So H. And I mean, as we're doing this question, maybe if you have a screenshot of your question or if you've written down the points as I have and you're following along, then you can compare H with C. H with C. C, to remind you, is saying that the balance in the prepaid account represents 3 months of rent beginning in September 1st, on September 1st of 2017, 2 months ago. So in C, we're talking about a full balance being carried into this month to where we could have, where we just did that 3 months, the balance in the prepaid rent account, and divided it by 3 to get a monthly amount, and then multiplied it by 2 to get your amount to expense at this October 31st date. Okay, so the difference here is that C is the full amount and H is the remaining amount. Remaining, that is a key word in H. Key word to pay attention to. That means we do not expense anything here. Because it was used. This is a remaining balance that covers the rest of the period, which is 2 years. The remaining balance of a two-year policy was the beginning when we purchased it on April 1st. April 1st is the date for everybody. So we purchased this prepaid insurance policy on April 1st. It covers 2 years. That means it will cover us till April 1st of 2019. But this is October 31st of 2017. That means 7 months have passed. So how many months are remaining in that 2-year policy? How many months in 2 years? 24. 7 have passed. That means 17 months remaining. So this balance in prepaid insurance, in this case, $32.30. H, $32.30 is the amount in prepaid insurance. Pre-insurance. That's from the unadjusted trial balance. But again, it's not the full amount, it's the remaining amount. The full amount would have applied to the full 24 months. But this is the remaining balance, meaning that adjustments have already happened. Yes, they do it once a year, but this question is testing how careful you can read the questions. Remaining, key word here. That means the $32.30 gets divided by 17 so that we can get a monthly amount for each of the remaining 17 months. A monthly amount for each of the remaining 17 months. Let's do that calculation here. 3320 divided by 17. Excuse me, 3230 divided by 17. 3230 divided by 17 is 190. Okay? 190. Each will be each of the next 17 months' value of prepaid insurance. Okay? And if we were expensing the 7 months already passed from April 1st to October 31st, now we would multiply this 190 by 7 if we were expensing it. But we already know we're not expensing it because that amount has already been expensed. It's already been expensed. We're dealing with the remaining value, so we just want to get a monthly figure to apply to this October adjustment. A monthly figure. And if you want to get a monthly figure, you have to multiply it by 12. Remember, 17 months here, 17 months means you multiply by 12 months. 12 months to give you 190 multiplied by 12, 2280. 2,280. Is the amount that will be adjusted for in this year. For this year. Okay? In October 31st of 2018, you will do it for the next year. And therefore the 2 years will be covered. No, they won't be. They're still going to go into 2019 actually. It's a 2-year policy, April 1st, but you will cover the amount in next year. That will be expensed according to that month. Or that range of time related to this October posting date. Okay? So that's the distinction to make. Let's suppose, hypothetically, this was a daily rate. Just to give you an idea how to calculate it daily, monthly, yearly, quarterly, whatever it is. Remember, stay consistent. 17 months remaining in the policy, that means you multiply it by the amount of months in the year. Let's suppose they said they do it daily for the next 17 months. Daily for the next 17 months. That means we would have to multiply the 17 by how many months, how many days in each month? Let's just say 30, right? 17 times 30 would give us what, 510? Is it 510? So that means 510 days in 17 months. And so then you would divide 3230 by 510 and then multiply that result by 365 to get a daily amount. But this would be if they were adjusting it in that frequency. You see? So that's why we're using the 12 here, because we're using the 17 months. And usually it will be a monthly figure, but just to show you why the calculation is how it is and why we don't use the 7. Remaining, the key word here. And it's directly contrasting to what happens in C, because that's the full balance being carried into this adjusting month. All right? And then A, finally, excusez-moi, you have I saying there's a count of supplies on October 31st. Of 610. Okay? Supplies, Oc 31st, 610. Sometimes the question will say supplies on hand. Remember, supplies is one of our main one of our 6 adjusting accounts. So sometimes it'll say supplies on hand, which just means how much is left. and you take how much is left compared to how much you started with. You started with whatever is provided in the unadjusted trial balance for supplies. So we go look at that. Supplies, 5,200. Okay? Supplies, I'll say October 1st, 5,200. So it has gone from 5,200 to now being only 610. That means we have used the difference. We've used the difference. What is the difference? 45.90. 45.90 is the amount of supplies used. If something is used, it is a expense. Which specific expense? With this, supplies expense. Go to the ledger, find the supplies expense account, debit it for the amount that you used, 45.90. The 610 still is remaining in that supplies account, and that will show after we do the next ledger update, which is going to the supplies asset and crediting it for the same 4,590. Crediting it for the 4,590 to show that the asset is decreasing because it's been used. All right? And now you've adjusted for supplies. Just like when you adjusted for prepaid rent. You had to credit the asset of prepaid rent to show how it has decreased. Why did you do it? Because you used the rent. Anytime you use something, you decrease that asset. All right? And that's I for you. Okay, I think we got it. So that's really the main part of this question, is getting those adjustments, updating the ledgers, and now you're just asked to take the balance in each of those ledgers. For example, with supplies, if we look at the supplies ledger, okay, this is the supplies ledger. I'll do it in a T account. We already know that a T account is, in essence, the same as a ledger. Supplies started at 5,200, so has to be on the left side. This number from the unadjusted trial balance. We debit it for 5,200, and now here you credit it because it's been used at the end of the month for 45.90. 45.90. Guess what's remaining? 5,200 minus 45.90 has to be the 610 that they already told us. So the 610 in the supplies account is the updated balance. And you're doing that for each of these ledgers. Getting a balance, a final balance amount for them. And now taking that balance, and the question asks you to put them into T accounts. So they're basically saying take just that final balance in each of the ledgers and put it into the T account to show just one number for each account. And then from that T account, from those numbers, now just copy those into the adjusted trial balance. Okay, we already know how to do that. It's a updated unadjusted trial balance. And now the financial statements become very similar to what we've already been doing. You're doing the financial statements from the adjusted trial balance now, as opposed to from the unadjusted trial balance. Take the revenues, deduct the expenses in the income statement, get a net income, take that net income to the statement of owner's equity. In this question, the owner's equity statement says that no additional investments are made, so you can directly add net income to beginning inventory, which is the beginning capital from the unadjusted trial balance, right? Beginning inventory is the beginning capital from the unadjusted trial balance. add to that the net income you just determined in the income statement, because there is no additional investments, and then deduct withdrawals to get you a net increase in capital, the net income minus the withdrawals, to add to that beginning capital, gets you an ending capital, and now you can do the balance sheet, and it's reminding you to just list those assets and liabilities according to liquidity. Liquidity, how quickly they are converted to cash, if we're talking about assets. If we're talking about liabilities, liquidity is how quickly we are paying them off. Are they short-term liabilities or long-term liabilities? Okay, short-term liabilities get listed before long-term. That's how it relates to liabilities. And then plugging in that ending capital number in the equity section of the balance sheet, the ending capital that you just calculated in the statement of owner's equity. So all of that is stuff we already know. The main parts are A through I. A through I, go through it again, rewind the video if you need to. But as far as the tests and future labs, and even the exam, I won't put a question like this on it again. It's good to know. I think it's sharpened you a little bit. You know, you started benching a little bit more weight than you probably can handle, but in the long run, it's healthy for you. Just don't make it a habit until you can handle it. And I'm going to help you not make it a habit by just giving you more manageable questions in the coming labs. You can see in lab 4, the questions are much more condensed. Tests and exam, you can expect all manageable questions directly related to the video. This one was a little bit stretching you a little bit, stretching out your knowledge and seeing how much you can actually handle. But hopefully the video helped. Again, keep adding the comments in the discussion boards. Any other questions you want to take up, we can do that. And test in 2 weeks. I'll put announcements on that. I'll update you, of course, on that. It is going to be on Blackboard. But for now, just look this over, do the practice questions in Chapter 4, do the lab in Chapter 4, and you know how to reach me. Okay, good for tonight.